Every financial boom tells people the same comforting story. Debt feels manageable. House prices seem like they'll rise forever. The stock market looks unstoppable. Everything appears to be under control. Until one unexpected event changes everything: a rate hike, a bank failure, a war, a credit freeze, a wave of panic, and suddenly people discover they were never as safe as they believed. Financial crashes don't just destroy wealth, they reveal who was actually prepared. Most people think surviving a financial crisis is about predicting it, selling at the top, buying at the bottom, timing the market perfectly. But history tells a very different story. Almost nobody consistently predicts crashes. The real question isn't, can I predict the next crisis? The real question is, can I survive if I'm wrong? Because financial crashes rarely punish people for failing to predict the future. They punish people for building a life that only works when everything goes according to plan. The first lesson is simple. Paper wealth is not real security. In 1929, the American stock market looked unstoppable. People borrowed money to buy stocks because prices kept climbing. Then the market collapsed, and the Dow Jones lost nearly 90% of its value. Overnight, fortunes disappeared, because market value and financial security are not the same thing. The second lesson is liquidity. During a boom, cash feels boring. Everyone talks about higher returns, bigger investments, and the next hot opportunity. But during a crisis, cash becomes freedom. It allows you to pay your bills, avoid panic selling, and take advantage of opportunities while everyone else is trapped. During the 2008 financial crisis, many of the people who survived weren't the ones earning the highest returns. They were simply the ones who had enough cash to stay alive. The third lesson is debt. Debt feels like a powerful tool when times are good. But when income falls or asset prices collapse, debt starts making decisions for you. It doesn't care that the market may recover next year. It wants payment today. That's exactly what happened during both the Great Depression and the 2008 housing crisis. Debt removes flexibility at the exact moment flexibility matters most. The fourth lesson is that income matters more than valuation. During a crisis, nobody cares what your house or portfolio is theoretically worth. The only question is, does it still generate income? During the Great Depression, farmers, small business owners, and people with stable income often proved far more resilient than those who were wealthy only on paper, because when everything else falls apart, cash flow becomes survival. The fifth lesson is skills. Markets can crash. Currencies can lose value. But useful skills rarely disappear. Whether you can repair, build, teach, sell, code, grow food, or solve problems, those abilities continue creating value regardless of the economy. Financial freedom isn't only about what you own, it's also about what you can do. The sixth lesson is diversification. History repeatedly shows the danger of relying on one country, one sector, or one investment story. Japan's asset bubble, the dot-com crash. Different decades. The same lesson. Diversification may never make you look like the smartest investor in the room, but it can stop one bad decision from destroying everything. The seventh lesson is an uncomfortable truth. When a crisis hits, the institutions closest to the system are usually rescued first. We saw it in 2008. Banks received emergency support long before many ordinary families recovered. Understanding who gets rescued first helps you understand how the financial system actually works. The eighth lesson is panic. Selling quality assets at the worst possible moment often turns temporary losses into permanent ones. But here's the part many people ignore. Patience only works if you can actually afford to wait. If debt, unemployment, or unexpected expenses force you to sell, emotional discipline alone won't save you. Preparation is always more valuable than confidence. And finally, the most important lesson of all. Real wealth is optionality. Cash gives you options. Low debt gives you options. Reliable income, valuable skills, trusted relationships, and a good reputation all create options. Throughout history, the people who survived financial crises weren't always the ones who predicted them. They were the ones who could survive being wrong. Now look around today. Household debt remains high. Housing is expensive. Artificial intelligence is reshaping jobs. Geopolitical tensions continue to grow. Markets remain heavily concentrated. No one knows exactly when the next financial crisis will arrive. But history consistently tells us what breaks first. Excessive debt, fragile income, overconfidence, concentrated investments, blind trust. So what actually survives a financial crash? Not hype, not blind optimism, and certainly not excessive leverage. The people who survive are those with liquidity, manageable debt, diversified assets, valuable skills, reliable income, and the freedom to avoid desperate decisions. Because financial freedom isn't about avoiding every crisis. That's impossible. It's about making sure the next crisis doesn't make every decision for you. Every financial crash humbles certainty. It exposes arrogance. It separates price from value and resilience from wishful thinking. In the end, the question isn't how much money you made during the boom. The real question is, how much freedom did you still have when the boom was over? If this video gave you a new perspective, make sure to subscribe. History has the answers. I'll show you where to look.